Coming up in today's video, we'll talk a little bit about the NASDAQ and some key levels that you should be watching right now. I'll also give you an update on my gold short position and some things that I am looking out for as we go into the end of the week. And the dollar seems to be getting a little rocky up here at these current levels. We'll talk about whether or not the dollar could see a push back down to the bottom end of this range pretty soon. And we'll talk about some of the ominous signals that the stock market seems to be running rampant around on Twitter about, and whether or not there is any merit to getting cautious or defensive or even shorting the stock market at these levels. As we get started, remember that this video is not financial advice. I'm simply sharing my thoughts and opinions, and everything on this is for entertainment purposes only. Without further ado, let's jump right into the video. Taking a look at the SPY monthly time frame, what you can see is that so far we are still seeing a dominant uptrend for most of 2025. Barring the April sell-off that we saw, we pretty much saw that bottom out. The market did not get the types of inflation that the market had feared at that time, and we have just been running rampant since. But clearly we've been in a one-directional push for quite some time, and this does not last forever. We know that stocks do not move in a straight line forever. They eventually will pull back. But the question, more importantly, is that time now? Timing is everything in trading, especially if you are shorter term in nature. You are looking to be not necessarily right over the long term, because if you say the market will move down, but you're calling it from here and then you're here and then you're saying it's going to come down here, it's going to come down here, right? That is a really losing bet over, time. You have to be right both in timing and in direction in trading, which makes it very difficult. That being said, I think it's really healthy that we would see a pullback in stocks, but I don't necessarily think that we have a strong conviction and this is the time to get short or call a top on the S&P 500. In fact, on the channel, we do quite the contrary. We actually look at market structure on the monthly time frame and we say, okay, look, we have higher lows forming each of these candles and we have higher highs. And if we are to get bearish on this market, what would we need to see from a higher time frame perspective? Well, specifically, I'd like to actually see that prior month's low get taken out at the very least if you're going to switch into a bit of a swing trading bearish perspective on the stock market. Again, monthly chart reversals, what you'll see here is that when we took out the prior month's lows here, that did lead to a shoot to the downside. But it's a really dangerous thing to assume that that we're going to kind of make that huge drop even though we're just off of all-time highs, because again, all-time highs typically do tend towards more all-time highs. So my personal opinion is that we should stay bullish on this from a technical perspective and still until there is more clear, obvious signs that we are reversing. Taking a look at the S&P 500 on the daily time frame, you can see that we have filled this gap that we left over here and now seemingly could be headed to even fill this gap, as price does seem to be, at least in the short run, on a pullback in kind of price action. However, taking a look at the S&P 500 or the US 500, what we can see is that we are now breaking through this resistance and actively retesting this prior area of all-time high resistance turned support. We had a really strong response yesterday from this level, and I'm curious to see if we come down and test it again, what happens next? Can we hold price action from here and start to push back towards those all-time highs, or are we going to start to see some failure on the daily chart, sending us potentially back into this range that we were in between September and October? I think from a daily chart perspective, in a longer term outlook, for that monthly chart to break, it would probably also coincide with a breakthrough that October 10th low. I think that if you started to see this, then that would be more decidedly bearish on this market. But until then, major levels, as we pull back to them, I would view as personally buying opportunities, not trying to short this market, right? So all three of these areas would be spots where I think the market actually would bottom out and start to move higher. And if I was completely wrong in that theory and all of these levels were to blow through, then I would start to say, oh, okay, price action starting to look bearish and we may be truly rolling over on a higher time frame perspective. One of the big concerns for people who are watching the stock market right now is that the tech sector specifically is incredibly expensive. Stocks are very richly valued. However, partly you could make the argument that the reason they're so expensive, they're so richly valued, is because the big ones at the top end of the spectrum are just killing it in terms of earnings growth. Today's video is sponsored by a brokerage that I have personally used for the last 5.5 years and absolutely love. The sponsor of today's video is Webull. With Webull, traders can trade US listed stocks, international ADRs, OTC securities, and fractional shares. You can also trade ETFs with access to over 3,300 ETFs. They also offer an advanced screener tool and research platform. And if you're an options trader like myself, you can check out their options platform, which I find personally to be super advanced, but also really easy to use. With their options, you can execute commission-free trades with support for multi-leg strategies, real-time Greeks, implied volatility data, and both equity and index options. And somewhat more recently, they launched futures as well for those interested in trading all sorts of different futures contracts. You can also buy and sell over 30 different cryptocurrencies within the app. And here's a couple reasons why I personally love Webull. Check this out. First and foremost, when it comes to trading costs, they offer zero commissions. And that's specifically commission-free trading on stocks, ETFs, and options. However, index options may have low contract fees, regulatory and exchange fees still apply. And one thing that sets Webull apart from the rest is their incredible charting software that they offer. It's super clean, easy to use, and pretty advanced. Their platform includes over 50 customizable indicators, 60 technical signals, for example, candlestick patterns and trend lines, Fibonacci retracements, multiple line styles like Heikin-Ashi, and so much more. And if you want to harness your skills before going live, you can also use their paper trading platform. This allows you to trade with real-time data with a risk-free environment. And just as cool as the desktop app is actually the mobile app, which I use all the time because it is super clean and easy to use. With Webull, you can have a cash account, a margin account, an individual or a joint brokerage account. You can also do traditional or Roth IRAs and rollover IRAs. And while there are so many other reasons that Webull is such a standout brokerage to me and why I've used them personally for the last 5.5 years, maybe the easiest reason as to why I like them so much is their super clean interface and some of the statistics that they actually show you when you are placing trades, etc. For example, the P&L calendar is like a super popular feature, and it's one that I've really loved having over the years. So if you're interested in exploring Webull yourself, check out the link in the description down below, or you can download the app on the App Store and explore it to see if it's a good fit for you. So sign up with my link below and take advantage of all the great offerings Webull has waiting for you. Now back to the video. And a stock that I own, which is Robinhood, ticker symbol HOOD, just put out their earnings report last night. It was a beat in terms of earnings per share. We also recently heard for Q3, Apple had a nice beat as well. Amazon significantly beat their earnings per share estimate. Google absolutely smashed their earnings per share estimate. Microsoft beat theirs. AMD beat theirs. And so you can kind of see where I'm going with this. Earnings per share estimates have been getting smashed by the big top players in the stock market. And while not all stocks are doing well, the really big AI names seem to be doing phenomenal. And so I don't know where the top of the AI story is. Is it a bubble? Probably. But bubbles can go on a lot longer than people think. And for now, earnings per share estimates getting beat like that tell me that corporate earnings are still strong and we had a really good earnings cycle. So for me, path of least resistance is for stocks to continue the party until something bigger comes along and breaks it. And I don't know what that will be. And as a trend follower, I will follow the trend. When we take a look at the Edge Finder's outlook on stocks and indices, we can see the Dow Jones is getting a very bullish reading. The NASDAQ also getting a strong reading. The S&P 500, and even foreign stocks like the Nikkei and the Chinese stock market are all getting strong readings. Notably for the Chinese market also, the Chinese central bank actually seems to be doing more quantitative easing, which we know is essentially injecting liquidity into a stock market. So global equities to me still look like they could have further upside to go. And until proven otherwise, I'll stay with the trend. Speaking of staying with the trend, specifically a trade that I am still in is the NASDAQ long position that I took on the October 10th sell-off. I bought that dip with a stop loss initially below this low here and have since trimmed my stop loss, then trailed it into profit, then trailed it into profit again. And I'm looking to see if we come down and test this area and fail, I'm going to take profits on the whole move. If the trade, however, can continue to hold areas of support like we have so far, I'm going to look to trail my stop loss if and only if we can break through the prior all-time highs and close decidedly above it. So essentially, I'm trailing my stop loosely on this one. Part of the reason I took this trade was because the NASDAQ was getting a strong reading within the Edge Finder, and we pulled back to a key area of support. I combined my technical trading strategy with the Edge Finder's macro fundamentals, technical readings, institutional activity, and market sentiment bias. On the day that I took the trade, the market was freaking out and buying puts aggressively. Let me show you. We're looking at SPX options flow over each day for the last few months. And what you can actually see is that that big October 10th sell-off coincided conveniently with a significant rise in options put volume trading. So a lot of people were buying puts on the big sell-off day that we saw. And interestingly, that signal created a short-term bottom, which gave me a really nice risk to reward entry point. Having the right data helps me to find better trades. And if you don't have a copy of the Edge Finder, here's how you can get it for the lowest price of the year. We're doing our Black Friday sale during the month of November, and everything is 40% off on the Edge Finder. The best part about it is it's not a subscription. It's not something that you pay every month. It is a one-time payment to get a copy of the Edge Finder, and then it's yours. All the future updates, you get them for free. You don't have to pay monthly. You don't have to pay yearly. It is a one-time payment to access our tools. And so somebody asked me yesterday, what is the actual cost of the Edge Finder? Because I hear you talk about it, but you don't mention the price. So usually it's $1,400, which is not cheap, we recognize, but these aren't cheap tools. These are quality tools that we've spent the last 4 years building, the last 5 years really planning and building here at A1 Trading. It's a really remarkable software that we've poured a ton of time, energy, and money into building. But with the discount that we're currently running, it goes from $1,400 down to $840, which is a one-time price. And we still know that's not cheap. If you need help into splitting that into an installment plan that works for you, send us a direct message using the first link in the description down below. And if you're watching on a TV or it's just easier for you to scan a QR code, simply scan right here. This will connect you to a real person on my staff. Just let them know you're watching today's video and you're interested in getting a copy of the Edge Finder, and we can help make that possible for you. Don't miss a sale. It is the lowest price we do all year long. So interestingly, we recently had another bearish reading in terms of bearish sentiment, I should say. It was a bullish reading in the way I use the put to call ratio. When the crowd sentiment gets really bearish, I take that as a bullish signal, and vice versa. Crowd sentiment got really bullish here towards the top. You can see prices kind of rolled over. People got scared a little bit, started buying puts again. It's an interesting story how this just kind of happens over and over in markets. Here's an overview of what the Edge Finder is currently finding. What you can see here is mostly our risk on assets are in the blue in terms of getting bullish readings. The Nikkei, Chinese stock market. Interestingly, Chinese equity markets seem to be getting really strong scores here right now. S&P 500, NASDAQ, and Dow all getting bullish readings. On the bearish side, we've got a couple currencies, and specifically US Treasuries also getting a bearish reading. Here's a quick look at our technical readings for the day. Some of our strongest trending charts in terms of just pure price action: Euro Pound, Aussie CAD, Nikkei, Aussie New Zealand, Dollar Yen, UK 100, Euro New Zealand, Dollar CAD. Interestingly, some of our more bearish moving markets are Bitcoin, NZD USD, NZD CAD, US oil, and NZD CHF. How is it getting these readings? Well, the technical heat map looks at three kind of categories. It looks at volatility, it looks at individual moving averages, and then it kind of combines it all to build this bias. If you're a technical trader, this indicator or this tool might be useful to you as well. Part of the reason I remain constructive on US stocks is because our economic heat map still shows some pretty good readings for the US economy. Now, I know there's problems in the jobs market, but if we look past that for a second and look at other aspects of the economy, like for example, services PMIs being quite strong compared to expectations, GDP growth beating expectations, inflation rising, but less so than analyst forecasts had been. So, the market is surprised in a positive way with less inflation than expected. I know that's a little convoluted, but that is how that works, right? Markets trade off of expectations. So if everybody expects inflation to rise a bunch and then it only rose a little bit, the market likes that, right? So that's another bullish thing for stocks. We have inflation still sticky, but not rising dramatically. ADP numbers also came in this week better than expected, which was a nice bright spot for what is a pretty ugly jobs market right now. Most of our indicators still suggest some strength for US stocks. Noticeably, the US dollar is also getting some pretty nice readings overall. And so I want to move on to our next topic, which is of course gold and precious metals. So if the dollar is looking relatively strong due to the readings that it has, how does that impact gold? Well, theoretically, a stronger dollar could put some pressure on the precious metals specifically. And so far we are back up to break even on my trade. I have a short position that is still open. We are testing resistance and I'm curious to see what happens here. If we do blow right through the tops here, then I'm going to go ahead and cut the trade and take a quick loss on this one. I'm short gold as of a few days back, and still slightly in the positive, but specifically from a price action perspective, if I'm going to remain bearish on gold, I need momentum here to continue. And what I mean by that is I need to continue to see lower highs and lower lows. I need to see this thing break through the lows. I would say we've just been in consolidation here. So I'm really keeping this quite simple. We can draw a box around the 4-hour chart price, and we can say, hey, higher time frame, we seem to have started to flip into what might be a little bit of a bearish move. But if we break this box up or down, that's going to tell me my bias in terms of technicals on gold. So let's say that gold prices from here bottom out and we actually start ripping through the highs. In that case, I need to cut the trade and say, oop, I was wrong, I'm out of there, and just move on quickly. This is, by the way, why I've been with my wife for almost 10 years now. Although if it was up to her, I'd probably admit I was wrong even more. And if this market does start to roll over, then my wife was still right, and I'll stay with the bearish trade and essentially look for continuations, right? So that's really keeping it that simple. I am kind of locked in this back and forth price action. I'd like to see where we break next. If it breaks higher, I'm out of there. If it breaks lower, we stay with the trend. A little bit of an update here as I'm recording this. The NASDAQ is pushing lower here. US stock market just opening up. You can see we are coming back down here, at least at the time of recording this. Again, I keep this stuff really simple in my videos because I don't need to complicate it much further than that. I went on this rant in my live stream today about how important it is to keep your trading simple. I'm trailing my stop loss from where I initially took the trade on the NASDAQ. And so if we come down here and fail, I'm just out of the trade. I'll take profits and move on to the next position. If we can hold these areas, which I think we could, but I'm not certain. I'm never certain in my trading, right? If we can start to push higher, take out these highs and keep going north from here, then I'll stay with the trade. In momentum, it's a really simple concept, but people have a tendency to mess this up. In momentum trading, which is something I'm really big in, all revolves around staying with what's working and kicking out what's not. So I'm long the NASDAQ. It's been working. If it no longer works, I'm out of there. That simple. Now, while I do trade the NASDAQ, I do also get a little bit more granular with it too. This macro screener within the stock box, which is another tool that we offer for those interested, stocks, options, ETFs, futures, etc., might be worth checking out the stock box. I'll leave a link in the description down below if you're interested in taking advantage of that Black Friday pricing we're doing right now. It does extend to the stock box as well. So the stock box looks at all that same macro that we talked about, but really isolates it specific to stocks. So also what's really cool here is it actually also generates sectors that may have stronger or weaker macro scores. So it looks at all this stuff, wage growth, CPI, NFP, PMIs, etc., and it picks out essentially which sectors are getting the strongest readings based on what we find up top here. The reason I love this is this tells me where I might be more interested in looking around for possible trades. Like for example, I am long XLY. Obviously it's probably going to be down like the market is today, but I am still long XLY, which has been otherwise, other than today, a really great trade. I bought the pullback on this one because again, Stockbox kind of has helped me to pick out sectors and areas. So if you know me well, if you've been watching my videos, you know I'm long XLY, I'm long IWM, and I'm also long tech stocks through QQQ. So I'm following along really with some of my ETF trading. I'm following along with what Stockbox is finding in the macro screener. Now let's talk about some of the more concerning bear cases out there when it comes to the financial markets. One of the big things that bears are very loud about right now is market breadth is absolutely terrible. And what does that mean if you're new? Well, basically think about the collection of stocks within the market. The stock market is kind of an interesting thing. When you look at the ETF SPY, the big companies carry a lot more weighting than the little ones. So Apple and Amazon, those companies hold a ton of weight to moving that SPY chart, right? The basket itself gets moved most heavily by the big things in the basket. Well, when you actually break it into its components and say how many of the companies within the stock market are doing well, it's actually quite low, which is interesting. So above the 20-day moving average, just 30% of the stocks that we track within Stockbox are above their 20-day. Above their 50-day, only 37, and above their 100-day, only 40%. So the point is, stock market's near all-time highs, and yet most of the stocks within are not actually doing that great. So it's kind of an interesting story. The bears would point out, hey, stocks under the surface are looking pretty weak. It is a worthy thing to look at, but I heard someone explain this really well. Market breadth is sort of like a temperature read, not a timing signal. If the market is doing really well, you should see lots of stocks doing well, and that is true. But if stocks are not all participating, that's not necessarily a signal to short now, right? So I do think it's worth acknowledging, though, that we do have narrowness in this market, and that it's really only the big tech stuff seems to be really doing well and holding up the market for now. But let's play devil's advocate for a second on this concept of narrowness in the market. So people are saying the Mag 7 is doing all the work, right? Specifically Apple, Amazon, all those names, right? They're doing all the gains. They're just hogging all the gains, and all the rest of the companies are not doing that great. So if, we are looking at this scenario and we say S&P 493, the rest of the market is not doing great, but the Mag 7 is doing pretty great, what happens next, right? Is that a signal that Mag 7 has to fall to join the rest? Or is it a possibility that the 493 could catch up and start to perform well? And again, this is why it's so controversial. The reason it's not a great timing signal, in my opinion, or data would tell you it's not a great timing signal when you have narrowness in markets, is because it could go either way. The Mag 7 could start to continue to perform well, and the other ones could catch up, or the S&P 493 could continue to fall, and the Mag 7 could fall even harder to catch up, right? They typically do kind of move. We don't usually see over very long stretches of time a specific 7 companies do that much better than the rest for forever, right? Eventually markets, stocks switch out. But my point with showing you this is that I think it's a little naive to assume that because the 493 are not doing particularly great, that the Mag 7 must crash, right? That's not a fair conclusion. I think what you could have, and I would actually lean in this direction as I am still bullish on the market, I'd say Mag 7 can probably keep doing well, but more likely the S&P 493, which has not been doing well, may have a nice collective kind of catch up, or the rotation trade may gain some legs to it. And it's been a really hard thing to time over the last few years because the Mag 7 just keeps going and going and going. So I'm not leaving the Mag 7 trade. I'm still very long, Qs and the big tech names myself, but I think that the catch-up trade may be a very viable one in 2 years end. I think you could actually have some nice joining of the rally from things like the Russell 2000. I'm long that one for that reason, and other names. So that's personally my opinion on that. Now going into 2026, I've talked about this chart every day for the last few months. I still think seasonality suggests we could have an end-of-year rally, as you have big hedge funds who have underperformed their benchmark drastically this year. This year has been a terrible year for portfolio managers because a lot of them sold in April, right? They sold that tariff sell-off. They got really scared. Trump's going to crash the market. They gave in to, the headlines, and they got out of there. And retail actually has been doing quite well this year. They bought the dip aggressively. We've talked about that on the channel, but big brokerages released information essentially saying net inflows were really big from retail clientele. Retail traders bought the dip, and they are actually on top this year for a rare occurrence. That being said, cautiously bullish from here is where I stand. What I mean by that is I'm not a fan of massive leverage and it's for sure going to rally into year end and it's certain and I should bet the farm on it. That's not what I'm saying. Cautiously bullish would say data suggests we could stay bullish for a little while longer. So I'm going to stay with that trade. Economic data looks okay. We have performance in terms of 10-year average performance. This is the best period of time, usually into year's end. The government shutdown is a worry, but I'm not going to worry about it until the market truly shows signs of needing to. I'm a momentum trader, so I follow what's happening, not try to predict what's going to happen tomorrow. Dollar index is sitting at a major level of resistance here on the daily time frame. I'm very curious to see how we react to this level. Is this thing going to pause for a little bit and then move higher, or are we going to reject more sharply? Watch how price action forms today. If you get a really strong close to the downside, to me that would suggest maybe you've got some short-term pullbacks or even a further sell-off to go on the dollar. But if you wick back up here, it's a good chance this might just be a reload before we push through those highs and maybe make that next leg higher on the dollar index, which I think we very well could. I think that the Fed has been a little bit more hawkish than people had anticipated, and trade dynamics, if they do continue to improve, if there's a deal between US and China, I also see that as upside for the dollar as well. Crypto continues to struggle here. Bitcoin back down to 102,000. I do think people are going to get a little wobbly if you get a strong close under 100,000. It's a big psychological level, and if that does kind of break, I don't know that, Bitcoin doesn't have the same sort of, if stocks drop and they're great companies, you can kind of just stow them away. I think that a lot of institutional activity has infiltrated into the crypto space. We know that the massive launch of ETFs and just involvement from Wall Street being at an all-time high makes me a little cautious on Bitcoin. If you start to see momentum really fail at key levels of support, we very well may have some very, very quick dumping that could take place because, again, Wall Street may not have the same perception of Bitcoin. They truly probably look at it like how I do, which is I think it's a momentum tool. I think it's a trading tool, but I don't personally, I'm not like a crypto diehard believer for the long term. And I am going to guess that a lot of Wall Street would feel the same. And so if you do get failure at 100K, something changing in the crypto space, it's a different market than it was 5 years ago when it was all just, kind of retail trading. Now it's very Wall Street infiltrated. We know that because, again, the launch of ETFs, we know involvement from many institutions, institutional clientele wanting access to it. So yeah, it's an interesting time to watch crypto, but I am not in it. I had a Bitcoin long position that I stopped out of, so I'm no longer in Bitcoin, just watching from the sidelines. And yields are dropping a little bit today after the sharp rise that we had in yesterday's price action. TLT, I'm still long TLT, so I bought a little bit more TLT yesterday during the kind of sell-off in bonds. So we'll see. This is a bit of a hedge in my portfolio that I still have live. Although I am bullish on the stock market in terms of a trading perspective, long-term, I've not been doing a lot of investing in stocks. I mentioned this chart earlier, but historical PE ratios are very high for stocks, and the forward-looking returns after periods of this are usually not very good. So what I mean by this is when stocks are really expensive, it's not necessarily a time to sell and it's going to turn around next month. But in the forward 10-year period, there's a lot of data that would suggest that when you have very high valuations in stocks, the 10-year forward returns are not very good. It's really simply when stocks are very low and you buy them, typically over a long stretch of time, they do well. And if stocks are really high and you buy them, stocks over the next 10-year period doesn't necessarily mean they have to crash, but they just will have suboptimal returns. There's not a certainty of that, by the way. We could break it this time. We could break the historical data and trends, but my opinion would be stay with the historical data, which tells you aggressively buying stocks in terms of investment right now, historically speaking, returns suboptimal returns. I'd rather stay a little bit more liquid and hedged and diversified in times like this rather than pile all of my available cash into tech stocks at the highs. It's my personal opinion. I'm not really investing in stocks heavily right now. I'm trading them quite a bit. I'm watching them every day, obviously, with this channel, but I am not necessarily investing in stuff that is on the tech side very aggressively at this time. Instead, I've been buying things like TLT as a way to sort of store some cash on the sidelines in case we can wait for a rainy day and have some cash on the sidelines for buying dips. In the meantime, owning TLT offers some dividend, 3.76%, and if the Fed does proceed to continue cutting interest rates, I think that this thing can rise. And remember, guys, if you want to take your macro trading and sentiment trading to the next level, get a copy of the Edge Finder. It's currently on super sale. It's 40% off. All the information can be found linked in the description down below. We'll see you back tomorrow.